Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial filing of Dash Network, but don't expect a smooth broadcast. With their history, there's bound to be a plot twist or two along the way. This report gives us a peek into how Dish Network is doing, what challenges they face, and what their plans are for the future. Let's see what story the numbers tell. Dish is voluntarily providing this report. We'll be skipping over a lot of legal jargon to get to the interesting parts. Dish Network has two main businesses, pay TV, which is your Dish and Sling subscriptions, and wireless, which includes Boost Mobile. Let's see how each of these is performing. There was a deal in place for DirecTV to acquire Dish's pay TV business, but it was terminated because some deadlines were not met. So for now, Dish still owns its pay TV service. Dish has been building out its 5G network, trying to become a bigger player in the wireless world. They have also received an extension from the FCC to meet 5G deployment deadlines for certain licenses. Dish is trying to retain its pay TV subscribers by providing better technology, customer service, and overall value. For their wireless business, they are trying to expand and grow their subscriber base. Like any company, Dish faces risks. They face heavy competition in both the video and wireless markets. Changes in how people watch TV and new technology may cause subscribers to cancel their services. They rely on T-Mobile and AT&T's networks to provide wireless service to their customers. This line tells us that Dish is a non-accelerated filler and not a small business. The a great value is said to be zero because the company is wholly owned subsidiary of EchoStar. Dish faces intense and increasing competition from providers of video, broadband, and or wireless services. Because certain competitors also own some of the content being aired on their channels, they have a significant advantage over Dish, whose largest expense is programming cost. As with any company, they must stay on top of new technology. With rapidly changing technology, including developments with AI, they face the risk of their technology becoming obsolete. The services depend on FCC licenses that can expire or be revoked or modified, and applications for FCC licenses that may not be granted. Now let's dive into the numbers and see how Dish performed. As mentioned before, DirecTV terminated the deal to acquire Dish due to missing certain deadline. Dish transferred assets to EchoStar worth over $12 billion, including wireless spectrum licenses. The FCC granted an extension to Dish's 5G deployment deadlines. Scrolling down through legal disclaimers, scrolling down some more, scrolling even further, the total revenue decreased by 6.6%, with both pay TV and wireless segments bringing in less money. Let's see more details. The overall operating income went from a profit to a loss as both the pay TV and wireless segments struggled. Let's zoom in on the pay TV performance. The pay TV subscriber base declined by almost 1 million, a loss of 8.8%. But the silver lining is that the pay TV RP, average revenue per user, increased. Skipping a lot of information. In wireless, the operating loss increased. Subscriber numbers are down, though average revenue per user is up. They are still losing money in this segment. They are expanding and now have a nationwide service. Skipping over some content. Dish has a long way to go to be a major player in the wireless industry. The market value is non-existent and they are filing with a reduced disclosure format. Scoping even further to the main section we are interested in, which is the financial statements. Aggregate value is zero, which we knew already. Let's move on. Scrolling past the table of contents, scrolling past more narrative. Scrolling a lot. Let's keep going. Skipping one row since I can't find a cell that appears once financial statements is common. Okay, scrolling past the table of contents again. Scrolling past more legal wording. Scrolling to the actual tables. And here we are. After this page, we should finally get to the financial tables. The most recent year shows a decrease in total assets as well. Scrolling one last time so we can read it smoothly. Here are the most impactful financial numbers. Pay TV continues to generate profits in the millions, while the wireless division is generating heavy losses. But these losses are shrinking, so that is a positive. The revenue decreases were consistent through 2022, 2023, and 23 and 24. To meet obligations, Dish is continuing to take on large amounts of debt. As part of the merger with EchoStar, Dish transferred assets and equity totaling over $12 billion in value. The fair value of these licenses could be subject to impairment charges. Now, what do I think of all this? While the company's direction looks a little uncertain, their pay TV business, while still profitable, is shrinking and faces intense competition. The wireless segment shows some promise, but it is still losing money. Their strategy hinges on building out this 5G network, but that requires lots more cash, and they have significant debt already. A key risk for Dish is its reliance on other companies like T-Mobile and AT&T for its wireless network. It gives them flexibility now, but what happens if those relationships sour or become too expensive? Dish needs to find a way to become more independent in the wireless space. My take is that it's a mixed bag. There are opportunities, but also real challenges that could make or break the company. It is really important to analyze debt obligations and understand future plans for the 5G network if you are thinking of investing. Thanks for watching. If you found this breakdown helpful, give us a like, leave a comment, and don't forget to subscribe for more corporate deep dives.